Let's take a look at chapter 2, and this will probably be the last chapter, at least for a long time, that I'll even review in this manner. We get into 3 and through chapters 3 through, I don't know, 14, 15. Mainly those are going to be problem chapters or exercise problems where you work on exercises that are in the book, and probably not a lot of need for me to lecture. And even in these cases, um, you can take this for what it's worth. We do go over some important concepts here that I think might help out a little bit as we go through some of the exercises, and particularly as we do our project 2. And so some of those things. So what are some of the basic financial statements that we're definitely going to look at, right? We're going to look at the income statement. Statement of retained earnings, is kind of at the bottom, generally speaking, of an income statement. Tells you how much we keep, as opposed to maybe paying out dividends or paying or doing share repurchases. Sorry, the balance sheet, statement of cash flows, huge thing, right? We need to know where our cash is at. So an income state, right? Income statement is something that we use to measure profitability over a period of time. Be it a week, a month. Week could generally be a little short, but say a month or quarterly or annually. The SEC requires that big companies, publicly traded companies, have to report quarterly. And we get access to that information. It's kind of wonderful that we can take a look at it. Now, that said, I'll also tell you that SEC requirements and IRS requirements are different, and thus you'll see sometimes some kind of weird things when you're looking at the public statements, I guess. So, yeah, this is presented in stair-step fashion. So we go through, right? You've got revenues or sales, minus cost of goods sold equals gross profit, and you take off then operating expenses, et cetera, which I guess we're going to go through here, right? Okay. You take out the operating expenses, and you end up getting interest or earnings before interest and taxes. It's always kind of important because it's nice to know, how much, as a banker, we always like to know that people at least had enough coming in that they could pay our interest, right? We weren't so concerned about the taxes, but we wanted to make sure they could pay our interest. Okay, and then you can take out the taxes, and you'd have earnings before taxes, which again is kind of a good thing. There's an example of an income statement. Get used to that. Kind of take a look at it, and you kind of see where we're at. They're all pretty much the same. Okay. There you go. Modern accounting, I guess. So, return to capital, right? So, returns to investors. Okay. Bondholders, they receive just interest, as do lenders, other lenders, which would be like banks, etc. So preferred stockholders receive dividends, okay, and there's different types of preferred. I'll tell you that preferred are not a real often used vehicle for raising capital. There's a lot of disadvantages as the issuer, as the company that would be issuing that, to doing preferred stock. Now, that said, there's a lot of advantages to the purchaser or the investor in preferred stock. And sometimes that makes it kind of compelling, if that makes sense, because a company can issue a preferred stock that has lower rate of dividends and maybe some lower returns, but because there's advantages to the investor, it works out okay. Sorry, I had to sneeze there. So, and then common shareholders or common stockholders, that's what we typically look at. And, if you follow the stock market at all, that's kind of what they're looking at, is the common share prices, etc. So earnings per share are huge. If I'm an investor, that's what I'm interested in, right? If I paid $100 for a share of stock, and that company earns $5 per share, technically my return's 5%. Okay, that's kind of a down and dirty way to look at it, and but it's not a bad way to look at it either. Statement of retained earnings kind of goes through that, right? Retained earnings, what they had, add in the earnings that were available, pay out some dividends. It increased. Okay, That's kind of important. When you look at some of the big companies, take a look at Apple and Microsoft. I'll give you a couple of examples. Loaded with cash, loaded with cash. They've been buying back stock, so you get cash dividends, but theirs would also be share repurchases, and they've been buying back stock at a pretty prodigious rate. That's kind of difficult in a sense because their stock price has actually been fairly high. So price earnings ratio, multiplier applied to the earnings. So let's go back to that example that I gave. If my earnings per share were $5 and I paid $100, and that's the current price, let's say, for the stock, what's the price earnings ratio? Well, it's 20. Okay, so the price of the stock is 20 times higher than what the earnings per share were. That indicates some expectations about the future of the company, and I think what they're trying to tell you there is that if you look at a PE that's a little higher, and anything over 20 is getting to be kind of high, the expectations are is that that's a fast-growing company. You get a more stable company, let's say a utility company like Northwestern or something like that. They tended to have a lot lower price to earnings ratio because their growth is kind of capped, right? They're not going to invent a new wheel for, it's going to make them a ton of money. They're just going to supply, electricity, natural gas to their customers. They'll kind of grow as the economy grows. So factors that influence, of course, earnings, right? The risk, risk always goes with rate, right? Debt equity structure of a firm. So, companies that have higher debt, can tend to have higher earnings, earnings, return on equity, I should say, because they've got more debt. Okay, of course, their dividend payout policy and management quality, etc. We'll look at one briefly here in a little bit. So, allows relative market value comparison of many companies. It kind of does. It's a down and dirty, again, way to look at it. A lot of us have been getting away from that. Firms with higher expected returns, that's kind of what I was saying in terms of growth, right? They have higher PE ratios. Price to earnings ratios can certainly be confusing, absolutely. And there's stocks and companies that just go crazy. I'll give you an example. Amazon, for years and years and years, Amazon didn't show a profit, so they had no earnings. So their price to earnings ratio was technically infinity. Well, what was Amazon doing? They were reinvesting every dollar, right? And in investing, it was creating expenses, but they were doing that, reinvesting every dollar, so they didn't show any income, but they were growing their business tremendously. They show income now. Now they do have a PE ratio. Here's just some examples, right? And these are from quite a while ago. So, but look at the changes, that take place, different times. Cisco at one time was a, high flyer, okay, 2001, 20 years ago. But by 2013, they'd become more of a stable kind of a company, and they still are. They're not really a fast-growing company, and so you kind of see that reflected in their price-to-earnings ratio. So limitations, right, of the income statement. It's a function of a lot of different things, okay? Day-to-day things can be different. A company might have a huge lawsuit against it, and it might get settled, and that might affect a year's worth of income, but it doesn't necessarily affect the company's ability to generate cash in the future. So, you take those things into consideration. So, flexibility in reporting, can make a difference too. So the balance sheet, right, indicates what we own and what we owe. Okay, delineates the firm's holdings and obligations, and it's a look at a company at a point in time, but items are stated at original cost basis rather than current market value, and those things could be either way. In some cases, for example, real estate. If you owned land out here, wherever, agricultural land, and you bought it 50 years ago, you might have paid $100 an acre for it, and it's worth $750 an acre for it. In a true balance sheet, you're still listing it as worth $100 an acre. even though it's gone up in value, by $650 an acre, you would still list it as $100 an acre. Okay, there can be some opposites to that too, where things have gone down in value faster than what you depreciate them, or you can't depreciate them. So, there you go. So balance sheet items, you start at the top and you work your way down, and it's based on liquidity or the ability to convert it into cash. Cash, of course, is cash. And then you get down to, marketable securities, accounts receivable, inventory, prepaid expenses, and that kind of ends the current assets. And you get into long-term or fixed assets, and you got investments, plant and equipment. You get total assets, total liabilities, end up on the right hand. Typically in a balance sheet, assets are on the left-hand side, liabilities are on the right-hand side. The one we're going to look at, it'll have top and bottom. Liabilities, you go the same way, though. It's the ones that are most currently due, and you work on down to the ones that have the longer term. And then on the right-hand side, along with the liabilities, you end up with the stockholders' equity, which is just simply the assets minus liabilities equals stockholders' equity, right? Basically the accounting equation, assets minus liabilities equals stockholders' equity. You can rephrase that in a couple different ways. Assets minus equity would be equal to liabilities, etc., right? Okay, and the stockholders' equity is made up of these things, right? There's an example, again, of a balance sheet. They kind of give you the assets in blue, liabilities in red, and black is the shareholders' equity. Net worth, right, is the book value. Stockholders' equity minus the preferred stock component. Again, preferred stock's kind of a hybrid debt and equity instrument, and so it gets treated a little differently. Market value, on the other hand, is something that's completely different. We're going to take a look at one when I finish today. We'll just look at it briefly, and I'll show you the huge difference between market value and book value, right? Okay, book value, again, is what we're doing, what an accountant does, keeping track of that. Market value is what investors are willing to pay based on, again, their future expectations. So market values, obviously, of concern to those folks. Limitations of the balance sheet, and again, I'll show you that when we look at market value versus a book value. But things aren't necessarily valued. A ranch, just as a good example, that has 50,000 acres out here. Again, might be worth $1,000 an acre if it's beautiful country, et cetera, but it might be on the books at $25 an acre. If somebody, an old guy, 82 years old, bought it, 60 years ago. So. FASB ruling on disclosure of inflation, no longer enforced, but there are some other FASB rulings that are kind of interesting on some of the investments and whatnot. We're going to get into that when we get into Project 2 a little bit. And again, some of that has to do with the difference between the IRS and the SEC. Okay. Limitation of the balance sheet, of course, we've talked about asset evaluation. Industry outlook, growth prospects, those types of things are not taken into consideration on the balance sheet, right? Here's some examples of market price versus book value. Now, back probably when this was done, IBM was still kind of a high flyer a little bit, and so it had a ratio of market price to book value 10 times. The market price was 10 times what the book value is. I'm going to show you one in a little bit that's far exceeds that, and it's a company that you guys are fairly familiar with. In fact, it's on this list, but it's 10 years later probably. So, statement of cash flows, right? This is important. We want to know, how we're doing with cash, and represents cash equivalents that are easily convertible. There's an advantage. The accrual method kind of keeps track on a constant basis. An example of that might be taxes, right? Okay, in Montana, for 2022, your first half of your taxes aren't due until next November, and second half aren't due until the following May. And yet that's an expense that's growing. It doesn't go away. It's going to be there. And so on an accrual basis, we would keep track. If our tax, for the full year, half of it in November, half of it in May, totaled $12,000, we would accrue $1,000 per month on our books so that we would kind of more accurately keep track of it. And that's kind of what the accrual method is. Some disadvantages. It doesn't pay total attention to the cash flow. So I'm not spending that $1,000 a month, but it shows as an expense on my income statement. Yeah. Sometimes for bigger companies that can be a big difference. For little companies, not so much, right? Cash flow analysis does help, kind of balance those things out a little bit, so you kind of know where you're standing, but that doesn't take into consideration the big check you're going to have to write in November for the first half of your taxes, right? We divide that up, cash flow from operating activities, and that's what a lot of people like to look at, because basically you're taking your revenue minus your cost of goods sold minus your expenses, your operating expenses, and you get that kind of a cash flow that's there. Which is kind of nice. You add back in depreciation, because that's one of the operating expenses. Okay. Cash flow from investing. I think we're going to go through all these, so I'm gonna hold off here for a bit. There's translation of income from operations to from accrual to a cash basis, right? And so you're taking. We're going to go through. Depreciation and all those things later, and we're going to go through some cash flow statements, so I don't want to overdo it right now, but basically you're taking the basics of your income statement, you're adding back in depreciation, you're maybe adding back in those things that you would be accruing but not actually paying cash, to give you an idea of what your operating cash flow would be. It kind of gives you an idea of how you would take a look at it. So comparative balance sheets to look from one year to the next, those are nice to look at. I always like doing comparative balance sheets probably as much as anything, because it'd give you I could look at it and say, oh geez, let's see, cash this year was 30 and this year it's 40. Hey, it increased by 10,000. That's a good thing. Right, and you could look at those things. When I was in banking world, I loved looking at comparative balance sheets. So, cash flow from investing activities are things like, what happens if you buy a piece of equipment? You have to write a $200,000 check. Your cash goes down by $200,000. You add in, a piece of equipment, and so that's basically what we talk about when we're talking about investing activities. There are other things. That was just one example. And financing activities are things that we might do. We might issue bonds, take out a loan. That's basically what issuing bonds is. We could issue common stock. We can also buy back common stock. We could issue preferred stock. Pretty rare. There's some other corporate securities. There's also, payment of cash dividends, or like I said, we can buy back stock as well. When you sell securities, be it bonds or stock, it's a source of funds, right? Payment of dividends and repurchase of securities is a use of funds. This kind of shows you a cash flow where it combines all those things. And again, we don't need to belabor that at this point, because we're going to go over those as we go along. So, things that we look at, right? How are increases in current assets being financed? In other words, are we going out and borrowing a lot of money and then that's giving us cash? Yeah, that's not such a good thing, right? Is there an associated buildup in current liabilities? Okay, there again, or long-term liabilities, right? Because that happens sometimes. How are increases in long-term assets being financed? These are important. In banking, we always like to try to match loans up with the type of asset. So if a person was buying real estate, that's got a long-term life, and so you could give them a long-term loan. If they were buying equipment, that's got a much shorter life, maybe 5 to 10 years, and so you'd want to match up that loan term, to the type of asset that was being purchased. If they were doing short-term, a lot of farmers and ranchers had operating loans, right? Short-term, right? They need to plant, put it in the ground. When they harvest, sell calves, pay it back. Short-term funds can carry some long-term needs, sure. Depreciation, again, is a non-cash expense, but it's not really a source of funds. It's just it's fun. It's an expense that shows up on your thing, but it's not something you have to pay out in cash. And so we add that back in. That's kind of the down and dirty actually way to do a cash flow, is simply to take a look at what the income was, add back in depreciation, and you got a rough idea then of what the cash flow really is. Just gives you some examples there. We'll go through some of those. So free cash flow, you're hearing more and more about that, right? So it's cash flow derived from operating minus any capital expenditures that we might have made on equipment, real estate, or dividends that we pay, or again, share purchases that we might have. Free cash flow is a big deal. As anybody knows, cash is king. Okay, so if you got a lot of cash, example of that was just today on the news. Microsoft just announced that they're going to buy Blizzard, Activision. Hopefully I got that right. It's going to be what was it, $69 billion? Seems like a lot of money. For Microsoft, that's almost pocket change. That will tax their cash reserves. They'll probably borrow a little bit of money even to finance that. They've got a better credit rating than the U.S. government, though, and so they can borrow the money probably at 1-2%. Anyhow, and they probably have enough cash they could pay for it, but I doubt they'll want to use up those cash reserves. So income tax considerations, right? Income taxes are progressive, meaning that the more you make, the higher your rate, generally speaking. Top rate's around 40%. That might include state, some foreign taxes, depending on the applicability of it. Lower bracket can be down there. The tax laws have changed under Trump. Corporate tax rates, I think that the top rate came down to 23%, something like that. You add in a state rate, though, of, in Montana, I think the highest is 6 or 7. So you're still up close to about 30%. Other states, those are higher. Cost of tax deductible expenses, that's kind of we'll take a look at some interesting examples of that later in the semester. How when tax rates go down, you actually your interest isn't as good a deal. That doesn't make any sense now. Hopefully, it will later. Depreciation as a tax shield. Yeah, sorta, right? Because you get to depreciate things, and you might buy a piece of equipment that you can depreciate over 7 years, but it's actually going to last you for 20 years. That happens. It helps you to finance that, I guess, might be a way to look at it. Yes. There we go. Now, quickly, I just wanted to take a look. So, Apple. So, Apple today, selling the day's range anyhow. It's $170 roughly. It looks like it's towards the bottom of the range now, $170.12. Doesn't really matter. But here, come down here and we look at its market cap, $2.78 trillion, nearly $3 trillion, right? Price to earnings ratio of about 31. That's relatively high, okay, especially for a big company that's been around for quite a while now. That's a fairly high number. Again, if we looked at some utility stocks, those types of things, you're probably going to be 10 to 15, might be the PE. Okay. So what is it? So remember that number, 2.78 trillion. I come over here and I want to look at their balance sheet, and this is kind of a quick down and dirty look at their balance sheet. But I'm going to scroll down. I'm going to do it fast. So total assets are $351 billion. Okay, so hell, their market cap is what, not quite 10, 8 or 9, 8 times that maybe. Total liabilities total non-current liabilities and something. Okay, anyhow, we get down here and their total equity. So their book value is $63 billion. That's all. That's all their book value is $63 billion. And yet the market believes that Apple's worth $2.78 trillion. Quite a discrepancy, right? I mean, what is that? That's 50 times difference, something like that. Okay, that's as of 9/25. Looks like that might be their year end. 9/25 of 21. It's kind of interesting for a different year end. So, yeah, on the other hand, how much cash do they have on hand? A lot. Okay, it doesn't show up a whole lot here. Cash, total current assets, it says 134. But if you come down here, in their case, they also have these investments. And those investments are typically in government bonds and whatnot. If you looked at their total balance sheet, so about 250 billion in cash that Apple is sitting on, which is, pretty impressive. They could have bought Blizzard Activision and shrugged their shoulders. It wouldn't have even hardly, been noticeable for a company with a $2.78 trillion market cap. I think Microsoft's market cap might be over $2 trillion too. So again, a $70 billion purchase. It's sizable, but it's not a huge deal for a company that size. Anyhow, I've rattled on long enough. Those are things that are kind of cool to look at, and things that are going to be important as we go through this. We're going to do a lot of worksheets and whatnot that are going to be with income statements, balance sheets, cash flows, etc. And then in Project 2, hopefully we're going to come back and analyze some of those very statements. So thanks. We'll talk to you later.